Good afternoon, good morning, depending on where you are. So this is a webinar, or in fact, what we were terming a live briefing to go into some of the detail that's come out of our annual report that has just been published, The World of Corporate Venturing, which is our annual look at kind of CVC trends. Um, we have an extensive survey of nearly 400 CVC corporate venture units globally, and that gives us an awful lot of information about what the real success factors are for units that are thriving from year to year and expanding and so forth. And so the report is vast and dense. And I think it's helpful to, spend a little bit of time exploring kind of what some of those things mean. So I think we have a fair number of people now joined. So I'll introduce myself. I'm Maya Palmer, editor of Global Corporate Venturing. And I'm going to be joined today also by Liz Errington, who's the managing director of the GCV Institute. And the Institute, of course, is to some extent informed by some of the things that we learn in this annual survey. Some of the learnings that come through the Institute also trickle back into what we put out in the World of Corporate Venturing report. So it's excellent to have Liz's take on this. And also Nicolas Sauvage, who's the president of TDK Ventures, but is also here today in his role as chair of the GCV Leadership Society. So he's speaking not only from his own experience with building up TDK Ventures, but also more broadly on behalf of corporate venture teams. We are going to take questions today, and would really encourage you, if you would like to ask Liz or Nicola or me, to use the Q&A function that you'll see at the bottom of your screen to put those questions to us, and we will attempt to answer them, as many of them as we can. So please don't be shy with that. We'll do this in two parts because there is quite a lot from the survey that we wanted to take. So I was going to start really here with just giving a little overview of some of the top level trends that we saw in corporate venturing globally this year. And then we'll pause for a minute to talk about some of the implications of those. And then Liz will take over and we'll go through some of the findings from the survey that we did of the various corporate venture units, which gives us a very granular view of how those units operate, how they're organized, staffed, etc. On the top level, it's fair to say that the most striking thing for us was that this was just a record year for corporate venture activity. Even at the height of the 2021 boom, we did not see this many teams. So more than 3,000 corporations globally made at least one minority investment in a startup in the past year. And you can see from the different sectors, it's really broad. Every sector has this kind of activity, some more than others, though, and we can come back to that. Areas like industrial, energy, financial services have been some of the ones where we've seen, the most active corporate investment. So the other really notable thing is that the rise in corporate venture activity has come against a backdrop where the general venture capital industry has still been in something of a decline. So the number of VC rounds has been going down every year, whereas actually we've seen, on the corporate side, they have been sort of plateaued in 2023, 2024, and then began to rise fairly sharply in 2025. So, not following VC, but doing something quite different. And then, of course, if you look at the chart about total value, that has now, grown significantly on the corporate side. So, more than half of the money in that's raised in startup funding rounds comes from a funding round that includes at least one corporate. The other thing that we look at every year is sort of the relative performance of startups that are backed by corporates and those that are not. And we've consistently found that there are fewer bankruptcies amongst those startups that have at least one corporate backer. And there is a higher tendency for them to have an exit. Now, of course, these figures don't differentiate between sort of a distressed sale, perhaps, but and something that's a multi-billion IPO. But in general terms, I think this shows that there is a higher tendency to see those exits for corporate-backed startups. Then the other one kind of notable thing is just the importance of AI. So a lot of the corporate dollars are going towards artificial intelligence startups. If you look, in terms of the number of deals, it's not so startling. But again, when you look at the value of those investments, it's very, very dominant. We'll have a little look at kind of what that tells us. Again, corporate venturing is also growing in other areas. So whilst AI takes a lot of the headlines, I think if you stripped that back, you can also see that we've seen a considerable leap in the number of investments in the healthcare sector and financial services. And industrial is the one that, it may be growing from a smaller base, but has seen a dramatic growth. And finally, CVC is a very global activity. So I think it would be fair to say that maybe a decade ago we would have seen that North America was the area where you most predominantly saw that. But now, there is investment across the world. The corporates that are investing are global, but they're also investing increasingly globally. So, into geographies like Latin America, Africa, and so on. I'm going to pause there because this is already a kind of whistle-stop tour of our data. And I'd love to bring in, Liz and Nicola now to kind of shed, put a little bit of meat on those bones of what this is telling us. And I think I'll start us off with, the first question for me really is like, why are we seeing this growth in corporate venturing that seems to be so divergent from what we're seeing on the general VC side? I don't know, Nicola, maybe you can jump in with your
Okay.
thoughts and observations from your point of view.
Well, first, I think we are seeing huge professionalization of corporate VCs, and that's becoming obvious in the last 10 years. I'm really happy to see that corporate VCs are starting to be more active all year. I mean, the biggest number ever. I think when you go to GCVI every year in Montreal, you can see the trends, and I think that the trend is upward. And I'm looking forward to the event in March where we can all meet and think about how to raise the best practices. Also, the first slide you showed, I was also very happy to see that deep tech is becoming a big thing for corporate VCs. So if you can show back the first slide, because I'm not necessarily sure about the number. I think it was 36% and 26% of the first two bars, which I think relates to the deep tech. And that I think is probably the divergence part, which is if we think about corporate VCs as helping the corporates know where to go and where not to go and where most of the disruption is likely to come. The previous slide, I think, yeah. So you have the industrial and the energy that probably is half of the parent industry sectors, which is going, I mean, with AI and with electrifications, is going to go through major disruptions. And I think the corporate VC is a perfect corporate venturing tool for the corporates to know how to identify early these threats, which could be existential, and to be able to address them upfront, to embrace them when you know it's coming versus just ignoring them. And so I think the divergence, back to your question about VCs, is VCs are looking at the next big thing. And clearly they have struggled in the past few years with returns of money, DPIs, which makes it very hard for them to get the next funds raised, which makes it very difficult for them to invest more. While for corporate VC, we've been very steady, I think, as an ecosystem, as an industry, and you show that in the slides. And I think that creates an opportunity for corporate VCs to be the reliable partner that can add more value than just capital. So yeah, I think all the signs are, I think, showing that we're at the inflection point of corporate VCs. And I think I've been on record in a podcast with Ilyas Tribulov, where I think we could probably do 10x in the next 10 years, like we did 10x in the previous 10 years.
And do you think there's these particular industries? So, I mean, you mentioned industrial energy there. There's particular advantages, I guess, there for having that sort of corporate investment. But is it more than just the fact that you can get some input from the parent companies? Is it also that just because they might actually need sort of slightly longer investment periods and all of those things as well?
Well, first, not every corporate VCs are the same. So some have an exploitation mission, which is about to help the existing business grow and be stronger. Some are explorations, like at TDK Ventures, which is more about where the business might go in the future or where it shouldn't go, and you're looking at a longer horizon. Um, so I think it really depends, but I think for the corporates, the corporate VC is giving them a glimpse about what's the latest innovations, what might be coming to disrupt them, what might be coming to help them to innovate. So, I mean, we had these discussions before about most companies publish their R&D spend as a percentage of revenues. And if you think about corporate VC, first, the number of people you need versus R&D is tiny, tiny. And when you spend money in R&D, it goes into equipment and salaries and all of that. You're never going to see that money back. The money you're going to see back, the return on investment from R&D, comes from the customer, the revenue from selling products and solutions. Well, in the case of corporate VC, you get all these insights, and of course, you get hopefully more than 1x, 2x, 3x the money back from the investments themselves. So I think it's going to be difficult for corporations to publish the investment of CVCs as a percentage of revenue, but I think it's going to become more and more common in the annual reports to explain how well the corporate VC and the various corporate venturing units, because there is other tools in the tool set, are bringing value to the corporates and to their customers.
Yeah. And I think this is something we'll get into also in the second part. But I just wanted to jump to you, Liz. You know, you work a lot with companies, sometimes at the point where they're thinking about setting up a CVC. And I just wondered if you had thoughts on what was the kind of appeal, I guess, of doing a minority investment program as opposed to the, you know, the R&D and M&A that Nicola mentioned, where you get full ownership. I mean, yes, it might cost a lot more, but you know, I mean, you then, so how do those teams, when they're making that case to corporates, how are they making that argument?
Well, I think that it's kind of the foundational premise or assumption that open innovation has got to be a key element of the corporate innovation toolkit, and that being able to engage with startups in any way is a good way, as Nicola mentioned, to avoid surprises, but also to have a seat at the table in the development of new markets or new technologies or new ecosystems. And I think that there are real benefits to taking a minority investment approach versus you know, an M&A approach, because integration is hard. And we see that particularly the venturing programs that are looking at M&A as part of that toolkit often are ones that are looking for new business creation opportunities, or you know, consumer brands, or in some cases technology, you know, acqui-hire kinds of opportunities. But you know, going back to the earlier question that you asked Nicola about, you know, what is different from VC, and what gives corporates the opportunity to have an advantage. And you know, there are many markets. I think healthcare in particular is one where CVCs are actually the partner of choice, because these are very complicated markets and ecosystems. They're highly regulated, and they're very, in some cases, they're very fractional kind of go-to-market approaches. So these are things that VCs really struggle with and don't have the ability to be able to address. But on the corporate side, you know, it goes back to the professionalization. And one of the things that's different is that the professionalization is not just on the investment side, but it's also on the business development or the engagement side. And so I think that's where corporates have, you know, real opportunities to you know, bring their superpowers to bear.
Yeah. And I suppose we're seeing, you know, a relative shift actually to that those kind of deep tech technologies now. I mean, with AI, and then with that dipping into robotics, the need for new energy sources, and all of the attendant things, that all is at the moment very much playing to where the corporate strengths are. Which actually, so that segues into a question I really wanted to ask. If we go to this slide, which was really looking at just how much artificial intelligence has played into this. I was interested in your thoughts on what we can read into this, because a very superficial view of this is, oh, it's jumping on the bandwagon and everybody wants to have a, some kind of toe in the water with AI. But I think it's a little bit more than that. And I think you had some thoughts, Nicola, that I thought were worth sharing on that.
Well, first, I have a new thought, which I didn't share before, which I think it's definitively a clear shift, but it's an infrastructure in the building. So, for example, right now on your left pie, you don't show web, but I'm sure that in 2003, web was starting to be a big chunk, and at some point, everything is included. And I think AI, especially in this case, I think it's not just the software and the models, but also everything that's related to powering AI. This is going to be massive investments. And there is no doubt that corporate VCs like VCs see the potential for it, see the disruptive element to it, and they have to understand what's happening and they have to invest in it. There was a question I saw about healthcare CVC and whether they trend to primarily financially purpose. And I think AI is going to be so disruptive in healthcare that I think they're probably not going to go all financial because there's so much strategic value for them to understand what's happening in AI. And also what's interesting is if I think about all the corporate VC whose mothership is a drug company, they have one advantage over every other CVCs. The parent company understands power law. Everything about drug discovery follows a power law where you have to do many, many trials. You have gate stage, like a seed and series A and series B, and only a very few drugs are going to make it and make it very, very big. And so if I think about other corporate VCs will not have necessarily the advantage of a mothership understanding power law, because the way they are structured is more about distribution type of outcomes, and therefore consensus is more driven. I think that makes it way more challenging for the corporate VCs to make big bets. But in the case of AI, I think everyone will probably agree that there's so many bets made all at the same time. It's difficult to see which ones are going to pay off. And I think we are going to see probably a even bigger power law, more opinionated power law than we've ever seen. So for me, it's the infrastructure in the building.
Yeah. But big bets. And actually that leads to, we had a really interesting question from Brandon Kaplan, which I think we could turn to, which is, which really relates to what size do you have to be to have a corporate venture unit. These are not, I mean, they don't cost as much as an R&D department sometimes, but they're not trivial bets. And so is there a rule of thumb? And also, I think, Brandon's second half of his question was, have you seen examples where there are smaller mid-cap companies that might be doing something effective?
Yeah. I think first, corporate venturing is not just CVC. So there are many, many ways to have a corporate venturing function at very low cost. And some can be very, very effective, like venture clienting. And you don't need a big team. You could have 2-3 people, and you could already do very effective corporate venturing that support your corporate. But my personal opinion, and maybe I will be provocative, is if you're a company with about $500 million turnover to 1 billion, I think you can afford a CVC, and you probably should have one. And then where I have a stronger opinion is as soon as you reach $1 billion turnover USD, I don't think you can afford not to have a CVC. I think unless you're in a monopolistic market and you are not worried to ever be disrupted, but if that chart is telling you anything, you're going to be disrupted. It's about how quickly you can address. I mean, look at what has happened recently with the sellout of all the shares related to the legal profession. Think about software as a service. This is going to go through a major disruption because the pricing, the business model is based on per seat pricing. And it makes sense when the humans are in the bottleneck of this. But once it's agentic, I don't know if the per seat pricing makes sense anymore. And so you're going to have major, major disruption. And I think if you're a software as a service company without a CVC with more than $1 billion turnover, you're in big trouble.
Yeah.
And you know, we do have some data on this too. One of the filters that we've set up on the Keystone benchmarking platform is parent revenues, because we do get a number of smaller corporations asking that very question. You know, do our peers at the similar size have programs, and what should those programs look like given, you know, the scale of our corporation? And it was interesting to see that if we looked at companies that were under $1 billion in revenue, that a number of them are really punching above their weight. And 50% of our respondents that fall within that category with parent revenues less than $1 billion manage more than $50 million in assets under management. So, you know, that's a pretty significant investment and commitment. So, yeah, we do definitely see smaller companies playing in corporate venturing and seeing this as a real opportunity to take their business to the next level.
Yeah. And
I
by
think
using
so.
that variety of tools, you don't necessarily need the mega fund, right? But you can still.
Exactly. And I think at the end, it's not a one size fits all. I think corporate venturing, from what I've learned, is you have to design it very well for your corporates. It has to respond to a very strong why. Why do you even have a corporate venturing unit? Why would you need a CVC, or why do you want to do venture clienting, or why do you want an M&A team? I mean, you have to have a very strong why, which is well aligned, and hopefully with the top management, but also across leaders in the corporates. And I mean, if you want to start small, I would say a venture clienting model where you're very, very clear about what are the challenges that you're facing today in your corporation and searching for the startup that can help. That doesn't cost much at all. You could have 3 people to do that, and it could already be very, very impactful. I just had yesterday an interview on my Corporate Venturing Insider podcast with Mirella Lisboa, and I think the way they do venture clienting is so, so smart. I would recommend after this one, you could watch that one, although it's not yet released, but it's not one size fits all. And corporate VC brings so much more differentiated values than other corporate venturing approaches. It allows you to work with entrepreneurs who are building the future. So if you're really wanting to understand what could disrupt you, there's nothing better than getting close to the people who are going to disrupt you, understand how they think, and how do you embrace these disruptions way earlier than any of your competitors. So I think that's probably how I'm thinking about it, is have a granular view about corporate venturing and all the tools in the tool set, and then choose the one that makes sense for your corporate.
Yeah. I'm going to ask you another size related question, which is just kind of, do either of you have thoughts on the ideal size for a fund? I know that will depend a little bit on the parent company, but what I would say is that, you know, we still see that the majority of corporate venture funds are sort of less than 100 million. In fact, a lot of them fall into that 50 million category that Liz mentioned. The ones above $1 billion, you know, quite rare. And you know, and then compare that to, say, the amount spent typically on corporate R&D. It's a tiny fraction. Is there an argument that perhaps corporates could be placing a little bit more into this category? Would it help? Would it make a difference?
Well, first, I think that fund sizing should be done the same way as fund sizing is done by VCs. So you should be very, very intentional about sizing your fund depending on what is the stage you want to invest, what is likely the capital efficiency of your investment going to be looking like, so that you can also size your reserves the right way. And of course, you're asking about funds, so I'm assuming fund-based corporate VC and not from balance sheet. And so if in the case of TDK Ventures, we invest at seed and Series A, that's a majority of our investments, which means we probably need a size of $120 to $150 million funds. And that is because we invest early, but we want to be able to allocate for follow-on investments, because most of the time we're on the board of the company. We want to help them succeed. We want to be there for the next round if they succeed meeting their milestones. And so we have our single LP funds, which have 50% reserve. And the reason it's 50% reserve is because it's a mix of digital transformation and energy transformation, which gives a nice blend of capital efficiency. While we have a multi-LP fund, our fund X1, which is all about electrification, decarbonization, where we know the portfolio we invest in have much higher capex requirements. And so it's much more likely we need to have more reserve. And so the first check is only 40% of the fund size, but 60% is for the reserve. And that may not even be sufficient. I think we are going to learn as we deploy it from Fund X1. So I think the fund sizing should be about the strategy you want to apply, back to the why you have a CVC in the first place. If you think that you want to improve your go-to-market, let's give that example, a go-to-market with partners who have already proven, they already have their first few customers, they are on the second of a kind type of approach. At that point, you probably want to invest in Series C or Series D, not earlier. In which case, you probably need a much bigger fund for even a portfolio of 15 to 20 companies. So again, I think that, and this is part of, I think, the professionalization we see in the corporate VCs, is the fund sizing starts to follow the best practices and the financial discipline of financial VCs.
What do you usually advise?
We're gonna talk about the importance of the portfolio planning and portfolio management in a minute. But I agree absolutely with Nicolas that your fund size needs to reflect your assumptions about how your investment strategy is going to drive the innovation charter that you set out for the program. So, but I think one thing that we're seeing that's interesting now is that on the one hand you kind of have a floor, and if you look at the U.S., North America, and Europe, more than half of the programs are bigger than $100 million. So, I think that our data set is a global one. So I think that tends to draw the fund size numbers down a little bit versus some of the more mature markets. But I think what's also interesting to see, and another question is there a maximum fund size? Because I think one of the things that we've seen is once, some of these funds get above $1 billion in assets under management, then, within the corporate accounting and finance and asset management scheme, then sometimes that would kick you into, a different category of asset and may put additional strains on the program. So I think that's something that's interesting that we're seeing as well, is it's
So
not
maybe there's this natural
ceiling, yeah.
There's a natural bracket. I mean, I've also heard it said that, 50 million is a sort of rule of thumb, maybe minimum size, because if you're much below that, then the number of investments that you can make or follow on from becomes so minimal that that feels like it's where people have their starting point. But it's interesting that there might also be an upper end that might have.
And the other thing that's interesting that we do see is a number of programs also have, whether it's an additional associated fund or access to, the ability to make PE, growth equity types investments to support, portfolio companies moving from their portfolio to the point where, there can be real value added in scaling and leveraging both the parent resources and additional capital.
We are seeing that trend a lot, actually, where we see there's a fund that might invest, but then for the very biggest transactions, that might come straight from the parent balance sheet. So, I mean, NVIDIA is a good example. Lots of more exploratory type, almost anything that NVIDIA does isn't small, in fact, but to the extent that they are, there's a clear divide. So that seems to be a strategy. I don't know if you're seeing that more and more, Liz, recently.
Maybe I should make a point, which is investing from balance sheet typically get a bad rep. And I think it's true that sometimes it drives the wrong behaviors, and maybe it comes from purely strategic point of view. But there are some advantages to invest from balance sheet. So when we talk about the maximum fund size, I think balance sheet allows you to make very big bets. I mean, if you think about what Microsoft did with OpenAI, if you had a fund-based approach, that may not be so easy to do this kind of big bets coming all the way from the CEO. But if I go back to the maximum fund size, I think it should be the same again as a financial VC. Some would do billion-dollar type of funds, but they have very different access and ability to deploy and to get good returns. I don't think that's necessarily what corporates need. What corporates need is probably not just the right sizing of funds, but maybe having different funds for different purpose. I know that Qualcomm has this kind of thematic funding, like one for India, one for AI, and so on. And that I think makes much more sense because you can have dedicated teams per themes, and you can have deep knowledge into different spaces. So I think that rather than having a big fund that does everything and that's very difficult, you can have multiple funds. And then there's also the one thing which is maybe not obvious is the bigger the fund, the bigger the commitment on you to return much more. And that dawned on me because we've raised 4 funds. Together it's $500 million. And for each of them, I've committed to the board of directors of TDK to do at least 2x. And of course, I expect 3x. And so I've committed already to return $1 billion to TDK. That's quite a lot on your shoulders. So if you go and you can get away with raising a $1 billion, I'm not sure that's necessarily helpful to you because you've just committed to return so much money and you haven't even started. So I think start small is probably one or so of my advice. I remember when I raised the first fund, it was $50 million. And one of the board members of TDK said, why not 100? And I remember saying, I prefer to work before we run, but don't worry. If it works, I will come back for more money. And they laughed. And then 2 years later, I came back. I said, I promised to come back for more money. And they laughed again. So yes, start small. And I think 50 is probably a good size if you have actually, I think exploitation or exploration mission, I think 50 is a good size. You probably could do less, but then you would probably be filtered out by entrepreneurs. So I think you probably want 50 as a starting point.
Yeah. Otherwise, you'd have a hard time doing follow-ons or actually spreading your risk across a broader portfolio.
Yeah. Now, I'm conscious because I want to, Liz, give you enough time to go through the second part of the slides, but I had one more question, which is actually, we had an interesting question in the Q&A, which was about success metrics and how do we kind of show those. Now, what I wanted to sort of come back to this slide because I feel that we have at least some, clear evidence that corporate backed funding benefits startups, but is the evidence on the other side as clear, and how do you make that case?
There's one thing which I love about our CEO, Saito-san, the CEO of TDK. He has a very, very simple view, which I love, which is it's either pre-financial or it's financial. So any strategic value has to be pre-financial, which means it should lead to a financial return for the corporates. And I remember when I started TDK Ventures, I was quite cheeky when people were asking me the questions I don't like to answer, which is are you strategic or financial? And when I wanted to be cheeky, I would simply say, we are pure financial. And that would shock everyone. And then I was explaining, yes, because from this $50 million fund, I want to return $10 billion revenue per year to TDK, which is a definition of strategic, which is a definition of a purpose of being pre-financial. And so I think at the end, our KPIs on an annual basis is all driven about what is the value we bring to the entrepreneurs, the TDK goodness we talk about quite often, and then the value to TDK. And this is now what we call TDK Ventures goodness to differentiate from the TDK goodness. And it's all about number of engagements, revenue generated from the engagements, roadmap items being added, or roadmap items being removed because it was not going to be competitive. And so we are always looking at what is the strategic value we bring to TDK from building towards a financial outcome. And if you do that you can kind of measure on an annual basis, and the team is all aligned. We have team KPIs, which are all aligned about that value to entrepreneurs and to TDK. And that represents a huge chunk of our bonus structure. Now, the question that it was anonymous, so I can't quote the person, was IRR, and I'm guessing funds return. That can be rewarded not on an annual basis, that doesn't make sense, but through your carry or synthetic carry system, which I know you have a slide showing that. A quarter of CVCs already have that type of structure. And that I think is part of our professionalization, which is we should not forget our pre-financial value. But part of the pre-financial value is the quality of our learnings and the quality of our investments. And the correlation between financial returns of the funds, so the IRR and the DPI, and the quality of the learnings and the strategic value you bring to your corporates, I think is highly correlated. And the way I've explained it, so I have my 50 portfolio companies behind me. If all of them goes to zero, financial return zero, strategic value, okay, nearly zero. You know where not to go, but that's really, really little. If all of them becomes market leaders and the next 20 billion businesses, financial returns, we will become number one VC in the entire world. So that would be quite amazing. But we would have built a network with high intimacy with 50 market leaders who could be customers, suppliers, partners to TDK. That would be a financial, strategic value of the roof. No one could provide that. And so what I'm trying to say is that this pre-financial value, one of the proxy of the value of that pre-financial is a financial performance of your fund because it shows you pick the winners. And you could apply the superpowers that you have built with your mothership to make them even more successful and more likely to be market leaders.
And what do you find, Liz? Because I think Nicolas always very, very clear on his kind of financial KPIs. But I know that this is the question that you get asked maybe more than most, is how do I show this? So what are you finding, Liz?
Well, I think in a couple of slides, I'll dig into that in more detail, both on the strategic and the financial side. But going back to your original question of, is there clear evidence that corporate venturing benefits corporations? And our experience has been, that in the first 3 years of a CVC program, that it needs to kind of demonstrate proof of the concept and get permission to move to the next stage. But beyond that, they need to be able to really demonstrate both evidence of the impact provided through the program, as well as some level of financial accountability, because programs that lose huge amounts of money aren't going to be around, no matter how strategic they are. And if we look at our data set, that I think the percentage of corporations that have CVCs that have made it past this first 3 years, and then even more importantly, made it past, the next 4 to 6 years, is increasing every year. So to me, that is kind of, de facto evidence that corporations are seeing value out of these programs. They're avoiding surprises. They have a seat at the table in the development of new markets and new technologies and new platforms. And they're financially accountable enough that they're not being shut down because they're, stuck on corporate costs.
And on that
Maybe
note,
I want to be provocative here. When you say corporate see the value, we're talking about the 3,000 or so corporates who have a CVC. If I'm right that we can do 10x in the next 10 years of number of CVCs, there are 27,000 corporates who don't yet see that value and that have not moved on. So I think
that's our job.
Yeah, in a way, everyone who's listening to this webinar are those who are already convinced about corporate venturing. I think the question is, how do we get the 27,000 plus corporates who could leverage corporate venturing to be even more successful? And if you think about success, it's about bringing value to society, bringing products that really add value to society. How do we help them to be even more competitive and to bring even more value to their customers?
Yeah, I think we need to tell those success stories. And but on that note, I'd love to turn this over to Liz so we have time to look at the other half of the slides, which is even more interesting. I think just in terms of which really look at the kinds of behaviors, structures, organizations that we're seeing are leading to success.
Yeah, great. Well, Maya mentioned that a big part of the World of Corporate Venturing report is the findings around our annual Keystone Benchmarking Survey. And the Keystone Benchmarking Survey is designed to provide comprehensive peer reference points around all of the key decisions that CVCs need to make, whether it's creating a new program, evolving an existing program, or optimizing an existing program. And let's quickly run through a little bit of kind of the high points of some of the data for the global population. Well, as we've been talking about, the best CVCs tend to be those that are both strategically relevant and financially accountable. And increasingly, this means investing both ahead of Horizon 2, Horizon 3, and in support of Horizon 1, the parent business, and having the ability to facilitate impactful parent startup engagement in multiple ways. And we're seeing that 42% of CVCs now do have CVC platform or business development teams that are set up to support their portfolio companies. And then we see another 49% have what Nicola was talking about earlier, venture clienting teams that are focused on driving commercial partnerships with startups. And these tend to be more mature, later stage, ready to do business startups, as opposed to the earlier stage emphasis that you see in many of the CVC investment portfolios. And we do see, if you look at the full toolkit, that sector and regional toolkit differences can be pronounced, particularly with respect to venture building, which is the internal creation of new businesses. We see built world, energy, and healthcare CVCs, particularly in Europe and Latin America, are most likely to operate venture building units. Whereas you can see here, it's only 1/3 of CVCs globally and only 1/5 of CVCs in North America. And as I mentioned, with 73% of our respondent pool representing programs that are more than 3 years old, then the ability to deliver portfolio level financial returns does become important. And ideally, those returns cover the cost of the program. Financial, and if you look at assets under management above $100 million, then we see that number raises to 40% and is actually the top charter priority for those programs. And if we look at financial returns, we see that 52% of our respondent pool say that they are targeting VC level or top quartile financial returns. And what the implications of this are is that it means that, as we were talking about earlier, portfolio strategy and portfolio management become more critical and more sophisticated. And as you can see here, almost half of CVCs are now employing VC type fund portfolio construction models for planning and for management. So at capturing the strategy and being able to track investment and risk and flow throughout the life of the fund. And we also see that now 1/4 are programmatically exploring secondary markets, both to generate DPI from highly valued later stage investments, but also to free up capital from assets that are no longer considered strategic. And we also see in a shift from the past where LP positions were typically seen as passive vehicles, now 53% also manage fund-to-fund investments that are expected both to widen the deal flow aperture, but also help them to meet returns expectations. And one other data point that we think really is a sign of the professionalization of the portfolio management function is that the majority of CVCs with assets under management exceeding 300 million employ either a dedicated COO, CFO, or dedicated senior portfolio managers. But despite the fact that even for financially driven programs, impact is really the name of the game for corporate venturing programs. Strategic impact is the raison d'etre for all CVCs. But what makes it so hard is that responsibility for achieving the strategic value targets is often shared with the parent corporation, which makes it harder to define, to track, and to communicate performance. We see that almost all CVCs say that they have a mandate to find transformative ideas. So to meet this objective, the ability to communicate insights and to provide advice remains the top strategic value driver for the vast majority of CVCs. And this comes in the form of CVC participation in executive or business unit strategy sessions, sharing of portfolio and pipeline learnings, and trends analysis and storytelling are really the critical value delivery capabilities for that set of value drivers. But reflecting the importance of Horizon 1, Horizon 2 innovation in CVC charters, more than 70% also focus on commercial engagement. And we see that commercial engagement or commercial impact tends to be communicated through 3 different types of metrics. The first are what we would call activity metrics, the second, commercial impact metrics, and then the third, anecdotal storytelling around key successes. And activity metrics tend to include things like the number of startups assessed, the number of briefings, the number of portfolio companies engaged with the parent. And we see increasingly that portfolio parent attach rate is a metric that is increasingly common. And 45% of our population are looking to achieve an engagement percentage of at least 50% between the portfolio companies and the parent. And commercial impact would be things like being able to measure ROI through revenues or savings or risk reduction or value of sales to the parent. But the challenge with that type of metric is it typically requires that the parent and the parent business or the business unit assume responsibility for the tracking and ultimately, are in a position to want to take credit for. So, and one kind of foundational thought around this is for senior executives, the narrative around the story can be very much as important as the actual numbers.
Can I jump in just to ask Nicola on this? I seem to remember that TDK has quite a sort of slick matrix of the startups and then the kind of business units that they're engaging with. And has that been a useful tool for you in the company?
Yeah, actually, you're talking about the engagement checkerboard.
Yes.
Which is, so we used to report all the engagements between our portfolio companies and the TDK teams. It became this very big presentation. And it's very complex and you want to go into the details. And then I remember our CFO telling me, Nicola, sorry, but I don't have time to read this. Give me one slide that shows me everything. And I was like, what slide to show you everything? How could I do that? Font 1. And then we ended up with this beautiful visual representation of a checkerboard. So think about a chessboard, but bigger or smaller depending on where you are. And all the lines are your portfolio companies. And it could be 5 of them if you only have 5. In our case now it becomes 50. And then all your distinct teams inside your corporates. And for us, we are now more than 60. And then the intersection of them as a color, which basically say, is it an introduction we have made? Is it an evaluation that's ongoing? Is the evaluation completed? Is it now design in? Design in could be their solution into TDK's products or solutions or vice versa. And design win means we are bringing revenue, it's in the market with it. And very quickly, you can see all these colors, and it's quite beautiful in a way. But what's nice is that every quarter we update it, and we start seeing the colors changing, and we see the progress or lack of progress accordingly. And that gives a very good visual element to all these engagements we are doing. But it also is really nice because you can do a total for each lines and each row, which means that for each lines, you can see how many of our portfolio company are engaging with many TDK teams. And for each row, you can see which TDK teams are really leveraging TDK Ventures portfolio companies and which ones are left behind, which means that very quickly, some people were like, hey, how come my team is not working on this? And that's really, really helpful. And for everyone to know, we have open sourced under the Commons license, this checkerboard. So every one of you could use that Excel spreadsheet. You can just ask and we will put it on the website if it's not already. And you can make it exactly for your own purpose. Mm-hmm. And what's interesting is if I think about corporate VCs, you need to be very, very patient, and you need your corporates to be very, very patient. And it's very tough to ask your corporate to be very patient if you don't show them why and that you're making progress along the way. And that checkerboard is both telling a story and visualizing the story at the same time in a way that's very accountable. So that I think I would recommend for any CVCs to download our checkerboard and to use it. It's going to help you in communicating to your corporates.
I think the other interesting point that you brought up sort of tangentially is around the importance from a parent engagement perspective. So almost being able to kind of inspire competition internally. And I think we do see a number of CVCs, using the number and the depth of engagement of parent personnel with the portfolio companies. And we see some actually have structured programs where they loop in HR to reward people for being involved in this way. So I think it's really powerful to come up with, what are kind of the top 5 categories, and then have a compelling way to address each, and to incent the parent to sell it and to sell their involvement.
So I know you have some more slides to go, and then I'll jump in with a few questions, because we are getting some people wanting a few clarifications on things like portfolio management. But let's fit a little more in.
This is the last one, and this is around team, and that we talked earlier about the growing influence and professionalism of CVC, and our data does kind of show that this is happening. That now CVC is now a career path versus a management rotation. So almost 2/3 of teams average more than 5 years of relevant experience. And we are seeing that the competition for talent has intensified, particularly, on the investment side, where 2/3 of CVCs recruit investment talent from institutional and other CPCs. And it's up to 75% for some of the larger, more mature programs. But, retention sometimes can be an even bigger challenge. And the loss of key team members means the loss of valuable network equity and institutional know-how. So we do see, as Nicola mentioned, that now 25% of programs do have access to special carry-like synthetic carry or bonus programs, in addition to standard base bonus and equity. And we see this number rising higher for more mature programs with larger funds and more independent operating models.
And it might be worth just double clicking on that, Liz, just because I think this 25% by itself really doesn't tell the story. I mean, I think you had some stats that showed really how it's been rising over time, particularly in the more, long lasting and larger teams, right?
Yeah, it's up to, for ones that we would define as more operationally independent. Some of them are balance sheet thesis driven, but also the independent affiliate and the GPLP, it's like 60%. Have financial upside programs. So it's a significant number that has increased. I remember 5 years ago it was only it was kind of hovering at 11 to 13%, and now the numbers are significantly larger. And it's not only a competitive tool, but it's also a way of providing credibility to the startups who like to see that CVC team incentives are aligned with startup incentives. And so that's another important component of.
I want to say something I think which is very fundamental, and it's back to this pre-financial and financial. When you build your synthetic carry or carry model, make sure that every team members in your CVC have access to the carry model. Especially not just the investment team, but the engagement team, and hopefully everyone in the team. That's how we design it in TPK Ventures. It's not just fair, it makes sense. You want everyone to be driven by the success of the portfolio, because if they become market leaders, all that pre-financial value become financial to your corporates as well as returns.
And you want to incent team behavior.
It's the right behaviors, absolutely.
Yeah.
There was we only have a few minutes left, but I did want to get to some of these questions. So there was one going back to the question of portfolio management. Is there what do we have in the Keystone data about how that has developed over time? How has that evolved? It's at about half now, but is that a rapid change?
I think that particularly with respect to the development of the use of these more sophisticated tools, as well as the employment of dedicated portfolio strategy and portfolio management resources, that definitely has has evolved over the last, I would say, over the last 3 years. We've seen that significantly, and particularly as we have a larger population of funds uh, that have 300 million and above in capital, where I think you can't not have this capability, and you need to be thinking about it and starting to track, like Nicola says, with Excel tools from the very beginning. But I think that being able to start modeling and looking at what the implications of your strategic innovation initiatives are is absolutely fundamental.
And seeing as we're coming close to time, I just wondered whether we could close off with a couple of kind of rounding out thoughts. And I'm going to sort of wrap into this the great question posed by Mark Silver, which was, also a little bit about how CVC itself might be disrupted via AI. So I'm going to put that in one general question, which is, based on the data that we're getting in, which is showing us a certain direction for CVC, but also general, activity that we're seeing in the wider market. I mean, where do you think, CVC is going in the next few years? I mean, Nicola, you talk about, doing another 10x of growth, but what needs to happen for that to be enabled?
Well, first, success stories. I think we are building success stories after success stories as a corporate venturing ecosystem. You're seeing companies making bolder and bolder bets in AI and startups. I mean, all the model companies would not be where they are without corporate VCs and corporates backing them and helping them. So there's no doubt in my mind that corporates are right center to the success of AI, and hopefully not the failure of AI with this musical chair that sometimes feel like. So I'm quite convinced that AI is going to become disruptive, and the companies that are not acting today without a corporate VC or corporate venturing tools are going to be left in danger. So I think and of course you don't drive people with fear, but you can show all the success stories of companies who invest in corporate VCs and how much better they do. And I think that we have, but I think there will be a power law type of outcomes also in AI in terms of how companies leverage them or not, early enough or not. And I think we will be able to demonstrate that corporates with CVCs would have fared much better than those without.
And
But
Liz,
I think going back to your question about is AI going to disrupt CVC, and I think that AI will be increasingly a huge enabler for CVC, particularly from a process perspective, for the ability to do more effective sourcing and due diligence and management. But fundamentally, the point I made earlier that network is equity, and it's a game about people. And I think the AI will help people to do their jobs more effectively. But ultimately, I think you need the people to be able to make it happen.
So maybe I finish with one tip when we talk about AI tooling for CVCs. I think AI tooling is only going to be as good as your people and your proprietary data. And so you need really smart people. I'm sure that's what you have. But you need them to write down what they learn, whether it's in our weekly updates at TDK Ventures, where everyone writes what they've learned during the week, but also the meeting notes. What did you learn from meeting an entrepreneur, from meeting an investor, from meeting a big company incumbent that could be a potential competitor? It doesn't matter. If you haven't written down what you've learned as a team, the AI tooling is not going to be helpful as much as if you had.
Okay, so that's a good note. I think to yeah, if you're not already doing this, or if you're perhaps in the early stages and starting from scratch, this is just a great practice to kind of really embed in there. So at this point, I think we could go on, but we have come to the top of the hour, so I'm really just going to kind of finish here. What we will do is for all the attendees and those who couldn't join us live today, we will share a kind of summary of the session and the slides. So you'll be able to, and we'll put that link in to the Nicholas's tracker, and so we'll give you all of that. Now, just to, some final sort of housekeeping notes. We do these webinars once a month. So if you enjoyed this one, check out what we're doing next. We also have a lot of in-person events, and we're coming up to one of our biggest, which will be next month in Monterey. If you haven't already had a look at what that involves, the lineup is exceptional. I mean, we're going to be at the heart of Silicon Valley, talking up to the people who are sort of making Silicon Valley happen right now. So I would really recommend it. And then for those who are more Europe-based or who perhaps want to have a feel of the kind of European tech ecosystem, the GCV Symposium in London in June is an excellent place to kind of really make a lot of connections that way. And then if you can't, make one of those, but you would like some more so really hands-on teaching, coaching in some of these areas. We have a lot of courses that Liz's team at the GCV Institute runs, everything from, courses for how to be more effective board members to really sort of, CVC for beginners type courses, and then ones that are very much geared towards kind of making a real impact with the program that you already have in place. So I would very much recommend those. Please also, if you have a moment, to give us some feedback on this session. We really like to make these, webinars and briefings as useful as we can for you. So if you have any tips from how we can make the next one even better, please do take the time. But thank you all, and especially a big thank you to Nicola and Liz for sharing and all the kind of condensed wisdom. Thank you so much.
Thank you.
Thank you.